All right, if you've been exploring oil and gas as an investment lately, it probably feels like two completely different worlds. On one hand, the tax benefits are some of the most powerful in the entire tax code, and you can offset active income in your first year in many of these investments. On the other hand, every investor forum makes it sound like it is the Wild West, blown out pro formas, delayed distributions or deals that just take a decade to even just return your capital. And so you are stuck in the middle asking the same question I hear from investors every week. Is oil and gas actually a legitimate part of a portfolio, or is it too risky? How do you separate real operators from the pretenders? And how do you actually diligence an oil and gas deal when you're not an engineer, a geologist, or even an energy expert? And everyone wants the tax write-offs, but no one wants to get burned chasing them. Today's guest is one of the clearest voices in this space, and he's uniquely positioned to answer some of those questions. Bob Fraser is the CFO and chief macro strategist of Aspen Funds, a multi-asset alternative investment firm with strategies in private credit, commercial real estate, distressed debt, energy, and more. He's the co-author of USA Today best-selling book, Invest Like a Billionaire, that just came out. He's the co-host of Invest Like a Billionaire podcast, and he's wildly known for his data-driven and often contrarian macro analysis. Bob takes a perspective very few investors have, and he's not just an oil and gas guy. He invests across all different types of asset classes. And in this episode, we're going to cut through the noise and talk right away how to analyze oil and gas as an LP. We'll break down some of the tax benefits and the risks most investors miss, maybe some of the underwriting assumptions that actually matter, and maybe some of the red flags Bob sees in deals. So if you're an accredited investor curious about oil and gas, but cautious because of the horror stories, this will give you one of the clearest lenses you've heard. And with that, let's dive in. Bob, welcome to the show.
Great to be here. Can't wait.
Yeah, I'm excited. So, I actually have a clip that I would like to start off this episode with. I haven't done this before, but we're gonna give it a go this time. And it's a previous short that your team has put together. So I'll play that right now.
If you're concerned about fraud risk, public companies are definitely the way to go. If you're concerned about market risk, then private REITs are the way to go.
So I would even say too, on the fraud risk for private REITs is a lot of sponsors, and especially the larger sponsors, will receive audits from third-party CPA firms, right? Which catches a lot of that and can definitely add some comfort level to the fraud risk and it not being Ponzi.
And this is accountants going in and really doing a deep dive and making sure that these numbers look right.
So I would love to kind of get your reaction to that. I think that's something that is not talked about enough, about why go into alternative investments in general, and what are some of the things you can do to mitigate your risk there. Can you tell us a little bit more about that topic as one of our first as we dive into?
Why go into alternatives at all? Well, alternatives are far superior to public markets in many areas. For example, if you're looking for income, it's not difficult to get, near double digits or double digit returns in income, in cash flows, in various kinds of products like private credit. And you can get liquidity in some cases. In the public markets, that's nearly impossible. In REITs, if you want to invest in real estate, you can invest in REITs, right? Real estate investment trusts, which are public vehicles, but they're really, I call them real estate sausages. It's like if you want a steak, get a steak, don't get a sausage. If you want a sausage, get a sausage. But REITs are far inferior. They are required by law to distribute 90% of their income. And what that means is they cannot access the most lucrative real estate strategies like value add. So value add is where you buy a kind of a real estate that needs some help. It needs some lift. And that means capital. Well, you can't spend capital in a REIT. We've made some of our best purchases privately buying from REITs who are, they can't do capital improvements on their projects. They can't do development in REITs. REITs typically trade at a premium to net asset value. The net asset value means the value of the underlying real estate. So imagine we've got an apartment complex, and you can buy it for $1, but if you buy it in a REIT, you're going to be paying $1.50 for that. And they access only short-term debts. There's a whole lot of reasons why REITs suck, and they're just not very good. So privates are far superior. There's a reason why the billionaires put 50 to 60% of their investments in private alternatives. There's a reason for that. And obviously people prefer liquid investments, which the public markets have. But what that means is there's called a illiquidity discount for private. So you get things at typically a 20 to 30% discount. And everyone knows you want to make money, buy stuff at a discount. So there's just a handful of, that's just off the top of my head, a few reasons.
Yeah. I'm with you. I think so, just to double click on that, right? Like alternative investments are really the only way where I know you can get real depreciation benefits or
exactly.
or cash flow, like you mentioned, right? Like you can invest in
Right.
dividend stocks, but if the stock drops 30% in value, the dividend doesn't matter.
Right.
So okay, so just as a quick highlight for everyone that doesn't know you, you've been syndicating alternative investments for a while. We're gonna dive deep into the oil and gas portion of the portfolio, but give us a high-level overview of how did you decide to initially start syndicating these deals, and you've done them across all different types of asset classes. So walk us through that process and how you got involved in this.
All right, I'll tell you my story. Very unusual. I was a computer scientist. I'm a computer programmer. I literally would sit behind a desk and write code. And we did it for 15 years. And loved it. I loved it. And then ended up starting a .com in the late 90s, raised $44 million in venture capital, grew it up to 300 employees, and then lost everything in the great financial crisis. In the .com boom. And really got a financial education during that whole process. I say I have a street MBA, right? And they're really good, but they're way more expensive. And so I kind of became a finance guy through that process. Ended up becoming a professional stock market trader after that, and worked as a CFO for a while, and began trading large piles of other people's money. Did super well in the public markets as a quant analyst and doing quant trading and macro strategy trading, and then lost everything again in the great financial crisis. And so wiped out twice by the public markets. And I just became allergic to the public markets. I just, they really do have a place, but they're narrative driven. It's a lot of, fear and greed. It drives things to nosebleed valuations and hopeless crashes. And it's no place to park the bulk of your money, to be honest. And so I was looking for something that had more control, right? That, the great financial crisis, here's the apartment complex across the street. Well, every investor in that may have lost money, but that apartment complex is still there, right? And that's the point, is buying real estate or something like that. People are going to pay rent regardless of what happens to the economy, regardless of what happens to inflation or AI stocks, or Bitcoin or whatever, So I wanted something with more control and started in that space. We actually started at Aspen trading distressed debt. So at a partner that figured out how to buy debt for pennies on the dollar. We made a lot of money for our investors at that point and just started growing that. But we never envisioned ourselves being the distressed debt guys, right? We really understood that there is a very big world out there, and we have a very diverse management team and partnership structure with a lot of diversity of experience, and so quickly began kind of our multi-asset strategies.
Cool. And what would you say is your biggest focus today? I mean, you do all different types of things. I think how I most associate you guys with is with oil and gas, but how should people think about Aspen Funds?
Yeah. That's very funny because depending on when you got to know us, you think of us as very different. So most of our investors think of us as distressed debt guys, and we probably have done a lot more real estate than we have oil and gas. But we're very prominent in oil and gas because we've raised several $100 million for oil and gas, one of the larger syndicators out there, and we have some of the best projects and pretty unique relative to other things that are being offered to retail investors. If you want to call us the oil and gas guys, go for it. But honestly, we're just as big in industrial real estate, and we're just as big in private credit as we are in those things.
Okay, I could totally understand that. Okay, so the bulk of what I want to get into here is oil and gas, right? I think I would love for you to kind of start simply with helping us understand the oil and gas universe. You just said that yourself that you've structured your products very maybe differently than others in the space.
Right.
Give, as an LP, you're coming into this and you're trying to understand this world. Lay it out to us as simply as you can.
All right. Well, and you had such a great intro. Where's the risk, and is it easy to make money? Obviously, we see Chevron and these big companies, and there's billionaires, from the Rockefeller days, made money in oil and gas, and they made a boatload of money. But then you hear about your neighbor who lost everything in it. So what's the story? Well, there's three major ways to play the oil and gas investment space, and it's downstream, midstream, and upstream. Upstream is where the oil is produced, so it's the pump jacks and the gas wells. Midstream is transport, it's pipelines, and you see a lot of MLPs, master limited partnerships in the public companies, Kinder Morgan and others that are big, giant pipeline companies and very boring businesses, right? They just, operate pipelines. And then there's downstream, which is terminals and offloading, things like LNG and other things. And all of them you can make money in. The midstream is really more of a toll road play, right? But where most people think about oil and gas is the upstream side. That's the production side. And there's several ways to play that. So, and first off, there's oil and there's gas. So different parts of the country and different wells produce different levels. Some is very gassy. Some wells are very, very gassy in the Haynesville, for example, and Louisiana, very gassy. Sometimes it's very oily. And then you have natural gas liquids and kind of this in between gas and liquids, believe it or not. And so there's all this range. So you have to know what is actually being produced, and they are extremely different commodities. All right. Oil and gas operate very, very differently from an investment perspective. So oil obviously is pumped typically in storage tanks, and then it's picked up by big trucks. Gas has to have a physical pipe from your pump jack to the processing terminal. And for example, in the Permian Basin in Texas, they don't have natural gas offtake infrastructure. And so you see literally being flared, and there's no alternative. You have to produce the gas in order to produce the oil. They come out together. And so you have to flare it. Kind of ridiculous. Other places you have gas infrastructure. So you have to understand these different commodities. They act very differently. Oil is a global commodity. It's shipped on tankers all over the world. We know this. Gas is a local commodity. Gas really is not shipped because it's got so much volume. I can't remember the numbers. How much gas it takes to make a barrel of oil, but it's a lot of gas. And so gas is primarily local. And so what happens is the prices globally for gas are all over the map. In Europe, they can be 2 to 3 times higher than they are in the United States. Natural gas prices. Same in Asia, because they don't have natural gas production. In America, it's very, very low. The prices are very low because we have a lot of production here. And so it's very local because you have to make pipes to pipe it around anywhere you want to use it. So they're very different. It makes gas much more volatile as a commodity, et cetera. So you want to know, first off, are you producing oil? Or are you producing gas? And you want to know the difference. As an investor, there's a few different ways you have royalty interest. This is where you actually own the royalty rights on the land. Okay. And you typically get a royalty. You get, let's say a 15% royalty would be typical. And a lot of companies out there, I've seen these investments being pitched, buy royalties, and they can be nice. But you can also be one of those things where you buy a royalty and you hope somebody drills, right? And you're waiting for decades for someone to drill. Well, it's more like buying land in the suburbs, buying a farm in the suburbs and thinking, hey, it's going to come to me. Well, it might, but you might wait a very long time. So royalties are not always a great way to play it, right? Because you're not in control of anything. It's really just up to the operators. Then the other way to invest is in what's called working interests, and that is where you basically sign a lease with the royalty owner, and you agree to pay them royalties, and then you work that well, you operate that well, and work it. You pay all the expenses for that well, and you reap the rewards for that well. What we do is we buy non-operated working interests. So we are not the operators. So our operators are Devon, Marathon, Continental, billion-dollar operators who their entire business is operations and they know what they're doing, and they really don't make mistakes, right? I mean, it's extremely rare for them to make a mistake. So it's called non-op working interest. So they own the majority of the well, and we maybe own 5% or 25% of the working interest in that well, which means we're liable for 5 or 25% of the costs, but we also get 5 or 25% of the income from that well. So those are some of the main ways to play it. One of the advantages of buying non-op working interests that we're doing is we're buying producing wells. So you think about the risks of oil, right? You have one, the geology risk. Is there oil there, right? Then you have the operating risk. Is your operator an idiot, right? Are they going to make a lot of mistakes or have cost overruns and whatever? And then you have the commodity risk. Is the oil price going to go up or down, right? We're eliminating two of those risks, and all at a third, engineering risks, right? It's just there's just a massive engineering thing of difficulty of getting the oil out of the ground. So we're eliminating 3 of the 4 risks when we're buying working interests that are already drilled, they're already producing, the oil is coming out of the ground, and it's operated by majors. So there's no geology risk, no engineering risk, really no operator risk. There's commodity price risk, which is plenty of risk, right? We can talk about what happened in 2016. We can talk about what happened in 2020 with commodity prices. That's enough risk, right? So what we're doing is we're buying these things, and they're just cash flow machines, right? It's just it's black gold. You're pumping gold out of the ground and you're selling it. That's our preferred way to buy. Now, you mentioned tax benefits. So one of the biggest draws for investors is this idea of getting tax benefits. And I was just talking to a guy who says, I went with this other company, and I won't name them, invest with this other company. They promised big tax benefits. Well, he got his tax benefits. He invested $100,000, got an $80,000 write-off, and that's it. If you want a write-off, go light a match, and take your money and burn it too. That'll give you a write-off. So what people don't understand is it's the IDCs, the intangible drilling costs, that are tax deductible. And it's a great deduction, but it only is for if you're drilling. And so what we're doing doesn't have as much tax deductions. It's not as lucrative because we're not doing a lot of drilling. Now we are drilling to do backfill. So what people like us do, you don't want to lose the value of your oil field over 10 or 20 years. So what you do is you do infill drilling. You do some drilling to maintain the production of your oil field. So we'll do that. And that does give you some tax benefits, but it's not like, you write a $100,000 check and get a $80,000 tax deduction. The other big tax benefit is called a depletion allowance, and you only pay taxes on 85% of the revenues coming out of an oil well. So those are some of the big the big ways to play, and the way we like to play, like I said, is these proven, developed, producing PDP non-op working interests.
What incentive does one of these big, huge operators have to even give your firm and in turn, the LPs investing with you a portion of the profits if they are going well?
Well, a lot of times it's historical. So, for example, maybe I held the lease. So I'm the guy that holds the lease on the land, but I don't have the capital to drill it. I mean, you realize, so these, and this is another thing I didn't talk about, it's horizontal versus vertical. A horizontal well can cost $8 to $15 million to drill it, right? So maybe I bought the lease and I just don't have the capital. So I will go to a big operator who's right next door, say, and I'll say to Devin, hey, I'll take 15% of this because I'm looking at my bank account and think I can fund 15% of that. But why don't you take the 85? And if they like the project, they'll do it. If it fit, they're next door, it's easy. It's bolt on. They'll do that. And then maybe that guy who owns the 15% will sell it to me later. So these are traded, pretty actively. So that's typical. And a lot of times these big operators, everybody's happy to get rid of a little bit of risk. I can buy a futures contract in the S&P 500 that lets me trade, $10 million worth of the S&P 500, and every point it hurts, or I can cut that in half and I'm maybe a little happier. So that's the idea, is just share risk, share reward, spread it around a little bit to get where you're comfortable with what you're spending and what you're earning.
So talk a little bit about, you've just talked about all the different ways that there's risk in these scenarios. And can you maybe discuss why do many oil and gas projects end up as zeros in people's portfolios? How has it gotten this bad reputation if it can be one of the most lucrative investments that you can make?
Yeah. There's more billionaires created in the oil patch than probably any other single business in the world. And there's a lot of money in oil and gas, but boy, there's a lot of zeros as well being created. And first off, it's people drilling, right? And drilling is not that easy. It's not that easy. It's very easy to get a zero, in spite of what the drillers will tell you. I went to one conference, and there's a guy selling a divided interest. I think it was a dozen divided interests in a single vertical well. So you're gonna buy 1/12 of this vertical well, and he was marking it up 10x. So it costs about $600,000 to a vertical well. He was raising about $6 million to drill this well, and you would get a divided interest in this well. Well, a vertical well, you pick a point and you drill straight down, and if you miss, you miss. That is a bug looking for a windshield, and you should never do anything like that. Horizontal wells are far less risky. They're way more expensive, but they're also much less risky. Typically, you go down about 2 miles or so, and then they're watching the geology of the rock coming up as they're drilling, right? And they know the layering they're looking for, the certain layers. Once they hit the layer, these layers, like rolling hills, maybe so once you get that, well, then you go horizontal into the layer, and that's where the hydrocarbons are. And the layers that have the hydrocarbons, and so you just keep that puppy in there. So you just keep growing along it. So they're just much less risky from a geological perspective. It's not a single spot. And you may go horizontally for 3 or 4 or for even more miles. These are just enormous wells, and very efficient. So vertical wells, buying divided interest in a single well, just please don't do that. Please don't do that. And then you have an operator that really is unqualified, right? It's easy to go get a lease. It's easy to go sign a lease with a farmer. It's easy to go get a driller, and you got a promoter. You've been in the real estate space for a long time, Pascal. How many promoters are there who are very good, right? And so it's even worse in the oil patch. Everybody's a promoter, and it doesn't mean they know what they're doing. They're qualified. I had a bad experience as well. in this space. That, the guy who was the great promoter and is actually a good property, he just was a terrible operator.
Yeah, I mean, I've had my fair share. I've invested in an oil and gas deal. I invested in a syndication of 10 wells, and the first 2 didn't hit. And, they
But you
managed
got
to
your
tack
tax
on.
deduction, right?
Yeah. I mean, the other wells are performing now, and they added 2 more wells, so now it's a patch of 12. But yeah, I mean, I've experienced firsthand how you could drill and nothing show up. You just mentioned a scenario where there was this operator who kind of like raised 10x the value. It's a $600,000 well, and they're raising $6 million. Is that happening pretty often? And how do you figure that out as an LP?
Well, go find out what they're doing. I mean, I just met the guy at the conference and said, "What are you doing?" And I just kept asking questions and until I figured out what he was actually doing. I said, "This is a single well." Yeah. "Oh, but our geology is all good. We're gonna, we really don't hit zeros." I'm like, "Okay, you're guaranteeing that, right?" "Well, no." And then I asked the price and what their valuation was, what they're raising at, how many interests they were doing and what the amount they were raising. I drill vertical wells, so I know what they cost and did the math. So just be careful. Any vertical, just be careful as an investor. Anything that's not a big operator, be careful. We're not geologists. The issue is you got, the big companies have world-class geologists, right? That are looking at this and making sure they're going to hit something. Do the little guys really have that? So I'd just be more comfortable sticking with bigger operators.
Yeah, look, I mean, I think as someone that's new to this space, it's very difficult to understand what you don't know, right? Like you understand that there are these big tax benefits. Someone comes across Aspen Funds and they see you guys have raised, several different funds. I think you guys have more than 7 now in just the oil and gas. And they could say, oh, well, Aspen Funds, they're a bigger operator, or they partner with bigger people. How does someone identify whether they should invest with an oil and gas operator or not? Like it's not very clear. Every operator presents all of this data. They can show, hey, here are all of our other wells, and they can maybe show production. Many of them don't show the actual returns to LPs, which I recommend people, you want to know what actually was returned to LPs. And if the operator won't show you that, then they're not getting any of my money. But what kind of questions should we be asking? How do we understand this better?
Yeah, the first thing, Pascal, is drilling. So you said you invested in, 10, 12 wells and clearly drilling. Well, you got to understand, if you're drilling, you damn well better know what's happening there. And why hasn't a major drilled this already, right? So to me, drilling with a small company is pretty much go to Vegas, so I would pick larger operators. The larger operators are simply not going to do this. They're not going to invest, in a $20 million, a $15 million drill hole without proper engineering and geology. And, even things like gas, if there's no offtake. So your smaller operators, I don't know that they have enough expertise. So just getting bigger operators. And of course, as you mentioned, look at the returns. I mean, we actually show the track record. Yes, we're just finishing up raising, closing at the end of this year, Fund 7. I can show you the returns of all of our previous funds, and we've never returned less than a 30% IRR, except on one, which was a 21% IRR. So that's actually showing cash going back to investors. Our Fund 6 we closed last year in February. In March, it started dividending at an 18% rate, and that's not even all the cash it was generating. So yeah, figure out what cash is being returned. But drilling, just don't make drilling the main thing you do. Get producing wells, right? Buy producing wells. And honestly, I don't know anybody at Aspen that's offering PDPs, right? Producing interests. And now you've de-risked. There's no drilling risk, no engineering risk, and no operating risk. It's just cash flow. You're taking commodity risk.
Got it. So basically your thought is, one of the big reasons investors get into it is because of the huge tax breaks,
That's right.
and that there is the tax. And honestly, it's a big, like, don't let the tax tail wag the dog,
Absolutely.
which
I've
is
seen some of
very
the
hard.
most stupid investments made because people don't want to pay the taxes. I have a chapter in my book on do the math on taxes, and people make the dumbest investments. I've seen, for example, 1031 exchanges and DSTs. And some of the worst investments you can make are these DST investments. That are throwing off. I mean, I just wouldn't invest in them. They're so much worse than the real estate deals we're doing, right? But yeah, you're saving your 15% capital gains, but you're losing 50% of your returns. It's just do the math. Sometimes it's better. Just pay the tax man, you know.
Okay, so I'm hearing here drilling is the most risky part of this
Absolutely.
business. So if you are going to be investing in oil and gas and you don't want to, and you want to reduce your risk or invest in already producing wells, why do you think all of these other operators in the oil and gas space get away with making these big promises, raising a bunch of capital from LPs and losing their capital?
Why does anybody get away with that? I mean, I think it's there's always a shady operator. I mean, one of my partners said that a definition of an oil well is a hole in the ground with a liar on top. And I like that. But how does anybody get away with it? It's just you can be a good promoter, and it's buyer beware. And there's a lot of good promoters out there.
Can you talk a little bit about what types of returns should we be expecting in these deals?
Okay. Well, I can tell you what the last two funds we're buying. So last year we were buying at what's called a PV30. I mean, it's present value 30%. So we're buying it at a cash flow of 30%. That means over the 10-year lifespan that we're underwriting this, we calculate that at $60 oil, which is the strip, the Oklahoma strip that everybody prices on, is the future price of oil projected for the next 10 years. And at the decline curve that we are currently experiencing in this oil well, we will earn a 30% return, cash on cash. Okay. And we pay the price for that well that earns us a 30% return. That's how we determine the price. It's called DCF pricing, or discounted cash flow pricing model, right? That was last year. We're buying at DCF 30 or PV 30. This year we're buying a PV 20. So the prices have gone up. But prior to the great financial crisis, you're paying about double those prices. So the prices are half what they were prior. So we're buying PV 10 and 15 prior to the great financial crisis, believe it or not. So the prices are very, very low right now for these oil fields. And when you buy producing wells, you typically get what's called proven undeveloped reserves. Proven means it's actually a legal term. It means there's a mathematical model for a hydrocarbon reservoir. That's a proven reserve. Proven undeveloped means it's proven that we know there are hydrocarbons in this reservoir, but it's undeveloped, and we get those for free. So yeah, so we're paying right now at a price that gives us 20% cash flows, including decline curve, including the current price of oil, and we're getting the undeveloped for free. That's typically the price we're paying right now. Right now, we're buying our previous fund 6 was buying in Oklahoma, the Anadarko Basin, Scoop Stack, and the new fund is in the Powder River Basin in Wyoming. Both are excellent basins with proven geology. So you could expect to earn a 20 to 30% return unless the oil price goes haywire or the gas price goes haywire.
How are you going about identifying which, what to purchase or what to add in your portfolio?
And it's really opportunistic. So it's really what is being sold. So right now, with oil prices, hanging out at $60, no sellers are very excited about selling, right? And your house dips down and Zillow's saying it's touching the bottom, where it's been. Are you excited about selling your house?
No.
And yeah, so that's what's happening right now. So we're going where the sellers are, we're finding amenable sellers. And a lot of times these are These are private equity funds that are kind of running end of life, and they're watching the oil price going down. And we're hoping they're watching the oil price go down. And gosh, I want to sell it before it goes down even further. And so it's actually a really good time to be buying right now because there's a lot of pessimism about the price of oil, which is great.
Yeah, talking about the pessimism, one of the conversations that's come across is, with Trump being very pro energy and drill baby drill, right? You would imagine that there's going to be increasing demand for energy with AI and data centers moving forward. But also, if there's much more supply coming on the market and the reduction of regulation so more people can get into the space, you would think that anytime you add more supply, I mean, Trump is trying to bring down the cost of energy as it influences everything else. So, can you talk about being in the energy business and having, I would imagine, your returns be based off of the price of energy, and having a president who's actively trying to bring down the thing that your business is built around?
Right. Um, that's interesting versus having a president who is trying to, bring up the price of oil to encourage transition into renewables, but they're the ones that are passing restrictive environmental laws, et cetera. So, which am I more afraid of? Um, the reality is neither one of them can affect me very much. Um, so you think about what Trump is doing, drill baby drill. All right, well, what can he do? Can he tell me to drill? I'm not going to drill if Trump tells me to drill. I'm not going to not drill if he tells me to not drill. It's my land. It's my lease. I can drill if I want to drill. When he says drill, baby, drill, what he's talking about is opening up federal lands, okay, so potentially new oil fields. Well, that's not going to affect anything in the next decade, okay? It takes 10 years to develop an oil field. If there hasn't been recent geology done, it's going to take years to do geological studies, environmental studies, et cetera, to map the hydrocarbons underneath and to put in engineering plans, get infrastructure, build pipelines, build roads, these things. It's 10 years. Okay. This is a very, very long game. It doesn't affect me in the slightest.
Wow. Yeah, I mean, that's fascinating. I imagine. And how do all the other players, like, he's gotten not softer. I guess he's wanted to bring nuclear back on as part of energy
That's
production.
even a longer game. I mean, I wish they would. So all these people that I was just in a conference, an LP conference, and there's a lot of hype about nuclear and these, small modular reactors, these things. But there's only one that's been approved. I mean, by the NRC, and the NRC is so backwards. Their job is to stop nuclear from happening, and we'll see if they can get out of their own way and do that. But it's going to take 10 years to get any reactors up. All these data centers that are talking about SMRs and that are really going to build these SMRs, they're also
SMRs?
saying small modular reactors, the nuclear reactors. There's the same guys that are saying we're going to build nuclear. They're putting in gas turbines for natural gas right now, and hopefully to be replaced by nuclear 10 or 20 years from now. So gas is the answer. If you want to play the AI boom, play natural gas. Natural gas is a super fuel. It is incredibly amazing. I don't know if people realize the same amount of energy that is a barrel of oil and the same equivalent of natural gas produces 50% less carbon than oil does. It's extremely clean fuel. It has, you think about it, it's a simpler molecule. It has fewer carbon atoms. And so it's a very, very simple, it's very easy to bring up a natural gas turbine. They're extremely efficient. These full cycle turbines, extremely efficient. They're cheap, they're quick to bring online, and they're very, very efficient. And natural gas is the only mechanism that is going to supply energy in the next 10 to 15 years. It's the only one. It's not going to be windmills. It's not going to be solar. It's going to be natural gas. Maybe a percentage will be those other things, but natural gas is the only thing that's going to fill the gap in the electricity need.
So if you're an LP listening and you're thinking through like, okay, you're hearing all these changes that this administration is making, these really won't have any effect on energy and catching up for a long time.
No, no. The bigger things that affect the markets, and just to finish the natural gas story, there's also a thing called LNG, liquid natural gas, liquefied natural gas. And what they do is they cool natural gas down to minus 240 degrees, and it turns into a liquid. And then they pump it onto purpose-built ships that are big refrigerator ships, and they ship it across the world. And so they're kind of oilifying the gas, right, if you will. And this being shipped to Asia. And what's happening now, everybody's super hungry for LNG because the Russian issue, right? They lost the pipelines from Russia to Europe. So LNG is becoming a big deal. Right now, it's only about 15% of natural gas production and natural gas demand, but it's growing rapidly. There's billions and billions being spent in this infrastructure, these giant terminals that are freezing natural gas and these ships that are building it. So it's a very small part of the market now, but very growing. To me, natural gas is the ultimate energy play. So where I want to put the bulk of my personal investment is in the natural gas play. So right now, if I'm wrong about the future of natural gas, you earn a 20% return, right? And if I'm right and it goes up, hey, we'll just enjoy that.
So to build on that, there are a lot of macro factors happening right now. You just referenced one of them with
geopolitical
Russia.
is the biggest area that affects this. Right now, we are the whole world expected China to recover economically, and China is this ginormous energy consumer, but they don't produce any, right? But what's happened, their economy is in the doldrums. And it's never really recovered. So what's happened is the world started producing more oil, and they're not consuming it. Right now, Goldman Sachs is predicting, saying for 2026, we have an oil surplus of about 2 million barrels per day on about 100 is the total demand, 100 million barrels per day. And so 2% kind of overage. It's enough to keep the price really soft. On the other hand, Morgan Stanley is saying by 2030, we'll have a 7 million barrel per day shortfall. And that's because there's a natural decline curve, right? Oil and gas is always declining, right? There's a depletion in these oil fields. You have to basically explore and drill 5 to 7% per year of new discoveries in order to just maintain production. And what's happened is for the last 7 years since the Obama era, there's been this narrative that we're post-fossil fuels, the world is post-fossil fuels. And so what's happened is investment into energy exploration development has dropped by 55% in the last 8 years. And that's going to bite us in the ass. Okay, so there's not enough exploration and development going on. And so we got plenty of oil today. What's happening, tomorrow's oil we haven't invested in. And so again, it's the perfect setup. We've got a price, a soft price right now. It's the perfect time to be buying oil assets, positioning and making cash flows if I'm wrong, right? I'm not right all the time, I like to think I am, but I get a percentage, right? But the smart investment is let me make 20 or 30% right now and then play for the upside. If I'm right and if I'm wrong, it doesn't hurt me. If I'm right, it's gravy. So that's the game.
Can you talk a little bit more about how, I would imagine that with Europe being cut off from Russia's oil and gas, that there would be much more demand today. And then, whenever that settles, there would be much more supply. Can you talk a little bit about how those types of geopolitics affect your industry?
It's the hardest part of this game, which is why, and no one can predict geopolitics, right? No one could predict that Russia was going to invade Ukraine and that Ukraine was going to blow up the pipeline. If they did, whoever did, you can't predict those things. Really, what you need to do is just hedge them. Most, like us, we're hedging about 15% of our production right now. So we're covering our costs of production by hedging, meaning we're locking in the price of oil and gas right now to about 15% of our production to cover our costs in case the price crashes. So we're safe, right? Is the idea. But yet no one can predict this. And that's why you want to not be super risky here. You want to not buy levered investments We're not leveraging, right? Hardly at all. We have a little line of credit. So you don't want to leverage this stuff because you really don't know. But yeah, it's super volatile right now. Europe is extremely energy constrained. They don't have enough energy. There isn't enough LNG production to keep the country working. And, you see the German economies, the European economies are just comatose right now. A lot of it is energy starvation. A lot of the energy intensive industries are moving to America because we have the cheapest energy, which goes into the reindustrialization of America, the trend that we're also playing at Aspen. But yeah, that's the hardest part of this. I mean, hey, Iranian oil and sanctions and
Yeah, talk
Russian
about like
oil
OPEC. Like, how does OPEC, they decide that they want to raise or lower their
right.
production?
Well, and so what happened? Here's a little story for you, right? This is people don't realize. So, do you remember the days? I don't know how old you are, Pascal. You look like
I'm
just a
35,
a
the
young
young
buck.
gun.
Yeah. So
Yeah,
you don't know anything. Yeah. No, I'm just messing with you. But
I know.
so. Do you remember the days when America was importing oil and when we were in fear for our future because we didn't have enough oil?
Totally.
And what happened? What the frank happened? Well, 2009 happened. In 2009, these guys invented this thing called horizontal drilling, and they figured they could put little hydraulic pushers on the end of their drills and steer these freaking drills underground 2 miles. You know how long 2 miles is? And go across these things. And they did this thing called fracking. And what fracking is basically using high pressure to fracture the rock. So what people think of an oil well is like this big, like swimming pool full of oil underground. Well, it's not like that. Okay, what it is, it's oily rock, and try to get something. It's like so trying to suck the trying to suck the your milkshake when you got the ice cube at the bottom. You can suck all you want, it's not coming out. Right? What do you got to do? You got to break up the ice cube. And so what they do is they use high pressure pumps to put little micro fractures in the rock, and they pump sand in there to hold those fractures open. They figured all this out in 2009. Again, whenever you think there's no solution and there's no future, someone invents something, right? In America, always in America, right? And someone invents something that changed the entire world. And now you have AI, you have internet, and you have iPhones and completely change and a whole different world. Well, that's what happened. And in 2009, the world went crazy, started fracking and this new horizontal technologies, and America started producing a massive amount of oil. And like Americans do, they went to the bank and they borrowed and they levered and they did what all the multifamily syndicators did in 2021. Raise as much money as you can, start hyping the crap out of everything and levering up to the hilt. And America became one of the top producers. Today, America is the #1 oil producer in the world. Yes, people don't realize this. We produce more than all the entire world put together, right? And sorry, not more than we're the #1 producer, not more than all the world put together, but #1 producer. So what happened? Saudi Arabia is going, hey, they did not like this. They were the big honcho. So they decided to show the world who's boss. And in 2016, they started cranking up the pumps, maximizing their production in order for the sole purpose of crashing the oil price. And they succeeded. So the oil price crashed down to $20 a barrel. They get hit 19. And all of a sudden, all these guys who are levered, you're levered. You got these debt payments going out to these giant banks. And you know what you do when the oil price goes down and you got your debt payments? You produce more because you're making less money. So you crank up your production, which does what? It just produces more. And so bankruptcies across the oil patch, the whole oil patch just went bankrupt, and a lot of money. I remember back then, juicing over buying the debt. You could buy the debt of these companies for 10 cents, 20 cents on the dollar. And a lot of billions was made buying that debt because you have access, it's secured by the oil fields that are great. right? Again, so much of the crisis is financial engineering crisis. It's not a financial crisis. It's not a oil crisis, right? Or it's like the multifamily crash. It's not a multifamily problem. It's a financial problem. There's nothing wrong with apartments, right? And so what happened? The whole oil patch went bankrupt. Not the whole oil patch, but a lot of it did, and huge bankruptcies. And what happened? The whole industry changed after that. The whole industry saying, okay, no leverage. We are not. So whenever somebody says drill, baby, drill, everybody's going, hey, I drilled, baby, drilled, and I'm not doing that. Right. So the whole oil patch is extremely disciplined right now because this is recent memory. And by the way, during COVID, we saw the oil price go actually negative for a day. There was companies that literally paid the refiners money to come pick up their oil. So trust me, Bob Fraser may be right and oil may be going to the moon, but there may be a bumpy road getting there and he may be wrong. So make sure your investment is not levered. Make sure you got it hedged, and make sure you're playing the long game.
You covered a couple of these things here. I have a list of things that you should look at when you're looking at a multifamily deal that most impact the deal. Like, what is the interest rate? What is going to be your exit cap rate? What is the rent growth assumption they're making? And there are a couple of these things where you can just very quickly look at the numbers and say they are being incredibly aggressive.
Mhm.
What are some of those for the oil and gas industry?
Yeah. Well, let's just throw out drilling, right? So anybody who's drilling, I don't know how you get comfortable with that unless it's a major, right? Unless it's a major, because otherwise their geologists just may not be worth a fig, right? I'm an engineer. All engineers are not the same, and all geologists are not the same. So how do you know who got the best one? The other thing is, are they pricing on the Oklahoma Strip, which is the standard, forecast for oil prices? So when you're doing a pro forma, unlike multifamily, your pro formas, right? You've seen that, people projecting, 10% rent growth per year.
Right.
I've
right.
seen that, right?
I've seen that.
And people projecting, yeah. Well, in the oil patch, you really can't do that. There's a thing called the Oklahoma Strip that says, here's what rent growth or oil prices are going to be for the next 10 years. Here's our estimate based on their best economists predicting this. So you want to make sure it's priced on the oil strip. You want to make sure there's audits being done. Audits are often overlooked, and you want to make sure that there's auditors looking at this to make sure that the operators are doing things right. Honestly, those are the biggest things. I think hedging, like I've said, you want to make sure it's unlevered. In the oil and gas patch, you want something that's extremely lightly levered or unlevered, right? And in the multifamily space, hey, getting something that's 65% levered, right? You got a debt at 65%. You're pretty safe at that range. Getting up to 80%. I remember stuff. I don't know if you saw this. People leveraging up 90%. Getting bridge funding, and then adding pref equity up there, and that's a bug looking for a windshield. In the oil patch, you don't want to see something more than 25% levered, right? You want to see it's almost all equity because of what happened in 2016, because of what happened in 2020, the oil price is extremely volatile. Now, if the oil price does go negative, you want to start buying oil as fast as you can with both hands because it's not going to stay there. Obviously, the world needs it, but the world goes berserk. And you want to make sure you can outlive the crazy, right?
Another thing that comes across very often is this idea of you can invest in oil and gas either actively so that you can use the tax benefits to write off your active income, or you can invest passively. And there's this idea that with many of these opportunities, you can invest the first year you are a GP and you can get those benefits, and then they convert you as an LP the following year. And the way that it's described, I talk about this pretty often with my brother about when you invest in that deal as a GP, in theory, you have unlimited liability, and you could lose your entire net worth, not just the 50 or 100,000 you invested. And so, can you break that down a little bit? How risky Is that a um, is that a normal structure? Is that common? How much risk is there? What have you seen go sideways?
Great question. And it is common for that reason that people want those tax benefits. And the only way to get it is as a GP, a general partnership. And most of these are structured such that there is not much risk. We did that in our first fund and allowed our investors to elect whether they wanted to be a GP or an LP. And as a GP, the risk you have is of course compliance risk, like legal risk, and let's say there's a slip and fall, or someone hurts himself on a rig, or you have environmental spills, something like that. But all that stuff is insured, so you want to make sure they have a good insurance policy. And that's the first line, not the GP. So GPs don't want to take any risk either, right? You've been a
Right.
GP in multifamily deals. Are you excited about taking risk? No, you're making sure you have insurance. You're making sure that you're covered. And so there really isn't a lot of risk. So insurance is the first one. The other thing is the debt risk, right? Typically GPs are guarantors. Now, I haven't seen anybody in the oil patch where as a GP, you're actually signing on the debt as an investor. So that's a bigger risk to me. It's someone who is, as a GP, when I'm investing as a GP in my real estate funds, I literally am signing as a guarantor on that debt. And that's a very big deal. I want to make sure that, if something goes wrong in this property, I'm not the guy that's going to be personally paying for that. But in the oil patch, I've never seen, as long as you're not signing that, you really don't have any risk there. So I've not seen that. So it is a legitimate structure, but again, it only lets you capture the IDCs really. So what we did in our eighth fund, we actually dropped that. It was not more work than it was worth, right? So you could be a GP in our fund and get IDCs, get the tax
Intangible
deduction,
drilling costs.
intangible drilling costs as deductions against your active income, but we're not doing enough drilling to make it worth your while. So it didn't even make any sense, right? So yeah, I'd be comfortable doing it. I would just check the insurance. I'd have your attorney look at it and say, hey, is there anything? I'd have an oil and gas attorney look at it and make sure you're not taking outsized risk. But I personally would be comfortable signing on a GP deal that was doing drilling after getting my attorney to look at it and just verifying the insurance policy is in place. And the GPs have something to lose too. I don't know that the GPs have some wherewithal, right? They've got their own wealth, and that they're not interested in taking those outsized risks as well.
Yeah, and that's assuming that you're comfortable with the risk of doing a drilling project in and of
Correct.
itself.
Right.
Now, as with any kind of capital raising, usually if you are participating in a GP function, in order to get the GP benefits, you need to have material participation. Is that similar here in oil and gas? How does that play out?
No, it's not. You don't have to materially participate.
Yeah, I think one of the things I've learned as I've been learning more about oil and gas is just how oil and gas literally just has its own section of the tax code
It does.
and behaves totally differently than any other syndication or real estate thing that you might be aware of.
That's absolutely right. And the reason they did that, back
Since 1913, it's when they started putting them into the tax code.
100 years ago, was to convince people to take the risk to drill, right? Because it is so risky. Now, it's a whole lot less risky today. 100 years ago, you didn't have, my son is actually a geologist. He's a top exploration geologist. And they have the technology they have is insane, from seismic to, just this array of computer models and AIs and all this stuff. And they didn't have any of that in 1913, right? It's like, hey, I thought I smelled oil coming out of the ground, right? There's a little leak, right? Let's go drill it, see what happens. And you're spending millions of dollars. So they wanted to over incentivize to make it happen. So it all made sense,
Yeah. Hey, Bob, this has been incredible today. Loved having you on the show. Really took a lot away. Where can people learn more about you, your funds? Obviously, you have the Invest Like a Billionaire podcast website. I'm sure people can go to. They can see some of your funds. If they go to Aspen Funds, where can people find you?
Yeah, aspenfunds.us, and take a look at my book. It's called Invest Like a Billionaire. It's available on Amazon. And I actually talk about, breaking down oil and gas investments in the book.
Would love it. Love it. Thank you. And as a reminder, if you are an LP trying to level up your skills, the best ever real estate conference is happening in February in Salt Lake City, where you can. I'm running an LP track. We're going to do some education. We're going to do some workshops. There's also some speed dating where you can go meet a bunch of other GPs and get to know who you might be interested in investing with. And also, if you're looking for deal flow, like maybe some of the deals that Bob has put together, you can always join my deal flow list at passiveinvestingstarterkit.com. And as always,
and I'll be there in February as well. I'm going to be
hell
at
yeah,
DC,
you'll be able
and
to hang out.
I'm presenting I'm doing my macroeconomics presentation, talking about where the world's going.
Yeah, exciting. Yeah, so you actually get to meet Bob in person, in the flesh. So thank you again for joining us on the Passive Income Playbook on the Best Ever Series show. This happens every Thursday. And until next time, talk soon.